Vanguard is out with its 10-year forecast and predicting a measly 5% annual return on stocks over the next decade. That is less than half the 12.3% annual return on stocks over the last 10 years. To put this into perspective, investing $100 a month at a 5% annual return and you're at just $42,000 over 20 years. But on the market's 12.3% return over the last decade, you're getting somewhere with over $100,000 saved. But if Vanguard is right, investors could be treading water for years. So why is Vanguard so bearish on the stock market, and should you be worried? I'll show you that forecast, but stick around and I'll reveal a simpler way to forecast your own stock market returns and how to invest. Here's that forecast from the team at Vanguard Capital Markets, and in this top section we see stock return estimates. Vanguard expects annual returns for U.S. stocks to fall between 4.1% to 6.1% over the next decade. Slightly higher, value stocks are expected to produce a return as high as 6.4%, so this would be something like the Vanguard Value Fund, ticker VTV, with its shares of 340 companies trading cheaply on that price-to-earnings basis. Surprisingly here, growth stocks seem to be what's holding the market back, with forecasts of just 1.4% to 3.4% returns. These are those technology and internet stocks that typically post faster earnings growth, like those in the Vanguard Growth ETF, ticker VUG, which versus that bleak forecast has produced a 14% annual return over the last 10 years. And I'll show you exactly how Vanguard came to these numbers, but basically it's saying growth stocks have had such a great run over the last decade and are at a starting point that could be overvalued, that returns forward are going to suffer. Real estate investment trusts, or REITs, here are expected to do relatively well, between 4.4% to 6.4% return, but it's those foreign stocks that Vanguard think is going to win big. Overall, global stocks are forecast to post as much as 8.4% annual returns. As for bonds, the picture isn't much better, but I'm going to tell you why these could be a better investment in a minute. Vanguard expects the overall or aggregate U.S. bond market to post 3.6 to 4.6% returns a year. That would be something like the iShares Core U.S. Aggregate Bond ETF, ticker AGG, with its 2.7% dividend. Intermediate credit bonds, so bonds of companies with credit ratings not quite the highest but still strong, are forecast to as high as 5.2%, while high-yield bonds, those with companies of lower credit ratings, could do 6.5% over the next 10 years. Examples here would be the iShares Investment Grade Corporate Bond Fund, ticker LQD, with its 3.6% dividend, and the High Yield Bond ETF, ticker HYG, with its 5.6% dividend yield. Now, what is really interesting here is the difference in stock and bond returns, or I guess the lack of difference really, and the volatility of the investments. Now, volatility on the right here is just a measure of that risk in an investment, how much you can expect the price to go up or down in any given year. In stocks, you can expect that roller coaster with volatility approaching 20% for some groups. Bonds, though, are much less risky, with prices usually only fluctuating maybe 5% or so a year. So the idea here is, if you believe these forecasts, then you would be much better off investing in bonds over the next decade. You'd be getting most of that return, as high as 4.6% in the aggregate bond group versus just 6.1% topside in stocks, but at less than a third the volatility or the risk. Now, I'll show you how Vanguard calculated all this, but first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now, Vanguard is pretty tight-lipped on exactly how it comes to that 6% returns forecast on its outlook, but we can put together most of these pieces. We'll use a method I'll show you later to forecast your own stock market returns, but it looks like Vanguard is expecting inflation around 3% a year, a dividend yield around 1.5%, and economic or earnings growth of less than 2% a year. Now, that would give us a total return around 6.5% a year for stocks, but Vanguard is saying that stocks are so expensive right now and are bound to come down to those long-term averages. We see here from FactSet that the current price-to-earnings ratio, that measure of how expensive stocks are relative to their earnings, is higher than the average. The PE ratio here around 22.2 times earnings, that is well above that 10-year average, and I'd put a more realistic average closer to 19 times PE. So if that stock valuation, the PE ratio, does come down to that long-term average, then instead of that 6.5% return, you'd probably be getting something closer to that 5.1% midpoint on the Vanguard forecast. Now for foreign stocks here, Vanguard believes higher dividend yields and a weaker dollar is going to boost the returns there by as much as 2 or 3% a year. Analysts at Charles Schwab have only slightly better news with their estimates for stock market returns. The dark blue bars here are the long-term average from 1970 through 2022, with U.S. large-cap stocks posting a 10.5% return. International stocks lagged that market with an 8% return, while bonds of high-quality companies posted a 6.6% return over the period. And the Schwab forecasts for the next decade are similar to that of Vanguard, but what's interesting here is the comparison from last year. The light blue bar is last year's estimate in October for that 2022 through 2031 returns, while the bar to the right is the new estimates for 2023 through 2032 returns. So Schwab now believes that U.S. stock returns, both large cap and small, will be slightly lower, only producing 6.1% and 6.5% returns. That drop contrasts with a new higher estimate for international stocks at 7.6% returns and bonds that are now expected to produce a 4.9% return over the next decade. Now, in those estimates, Schwab is forecasting 2.5% annual inflation and an average economic growth of just 1.8% for the next decade. Now, I'm going to show you how to forecast your own returns, stock returns specific to your portfolio next, but don't think these predictions are set in stone. Case in point, look at Vanguard's forecasted returns for 2012. So its 10-year predictions for the returns through last year. In 2012, Vanguard was saying 6 to 9% annual returns was the most likely outcome for stocks. They were doing these probabilities back then, which makes it far easier for them to hedge, saying, well, we said the other returns were possible. We now know that the actual returns here were 12.3% over that decade. So that 6 to 9% range, or about 7.5% midpoint, was almost 5% a year off. And so we see this underestimating again and again with these long-term forecasts. Wall Street always seems to be thinking that the glass is half empty on its outlook. I dug into my files to find the 10-year forecast by 5 firms from 2020. Here we were gripped in the middle of a pandemic, so some error is expected, but these forecasts were way off. Over the last 3 years since these forecasts, the market has returned 10% a year, and that's after a stock crash last year. So while I do think analyst estimates for stocks and market returns can be helpful in getting your own ideas, more important is that you know how to make your own forecasts. Nation, that's my mission here on Let's Talk Money, to make you a better investor and just give you the tools to make your own decisions. And making your own forecast for returns, whether overall market returns or even stock returns on your portfolio, actually isn't that difficult. There are a few methods, but I'm going to share the simple one here, just adding up a few estimates for 3 factors: dividend yield, inflation, and real earnings growth. Now, to estimate the dividend yield on stocks in your portfolio, let's use Coca-Cola, ticker KO, as an example. I'll first go here to the historical data tab and change the period to 5 years, then to monthly frequency and click apply. This is going to show me the dividends over the last 5 years, along with the stock price around each. And what I can do here is for each of these, multiply the dividend payment times 4, because Coca-Cola pays 4 dividends a year, and then divide that by the stock price at the time. That gives me a dividend yield at each of these payouts. So for the most recent dividend, 46 cents per share times 4 is an annual dividend of $1.84, and then divided by the $61.09 share price gives us a 3% yield. Try this one last year. A 44-cent dividend is $1.76 per share a year on a 58.53 share price. Again, a 3% yield. And finally, this 40-cent dividend, or $1.60 a year, divided by $49.63, is a 3.22% dividend. So Coca-Cola is pretty easy. The company tries keeping close to that 3% dividend yield. Of course, for Coke or any company, you have to use your analysis to determine if it's going to be able to keep up with that yield, but we're going to go with 3% here for our estimate. Now, for the overall stock market, you can use the S&P 500 ETF, the SPY, which right now pays a 1.55% dividend, but the average is closer to 2% long term. Now, these next steps you can take separately or combine them. If we look back on those Schwab estimates, we see inflation has been 4% long term, but expected to be around 2.5% over the next decade. Now, I'm thinking we get a little higher than that, maybe 2.75% inflation, but it's all pretty close. Long-term real earnings growth has been around 6%, but I'm thinking we see closer to 5% for the foreseeable future. So if we're building that market forecast, then that 2% dividend yield plus 2.75% inflation and then 5% real earnings growth, It gives us about a 9.75% annual return. Now, for an individual stock, you can combine the inflation and real earnings growth estimates by using just the total earnings growth. For this, we'll use Morningstar since it gives us 4 years of earnings data free, and we'll go to the Financials Data tab here and the Income Statement. Next, we'll scroll down and look for this Diluted Earnings Per Share, or EPS, and we see here in 2022, the company reported $2.19 in per share earnings. I scroll over here and we can see what it did over the last 4 years. So here in 2018, it reported $1.50 per share. So to find an annual growth rate, we take $2.19 divided by $1.50 per share, and we get 1.46. Now we have to take that to the power of 0.25 since it's 4 years here, and we get an annual earnings growth of 9.9%. Now just like that dividend yield, we have to ask ourselves if that 10% earnings growth is realistic and something Coca-Cola can do for over the next decade. For my research, I found that Coke's longer-term earnings growth is closer to 5.5% a year, but I'm willing to give them the benefit of the doubt with a 6% estimate for the next 10. So here, if we add up our 3% dividend yield and then a 6% earnings growth estimates for shares of Coca-Cola, we get a forecast of 9% annualized total returns, which is a pretty solid return. Now, most companies like to keep their dividend yield fairly consistent, so it's going to be your earnings estimates that's always going to be the most difficult and the most prone to error here, but this estimate is simple and straightforward. You can do this for each stock in your portfolio and then get an average for your overall portfolio, or one weighted by how much you have in each stock. Alright, if you're still with me, you're my kind of people, because I know this is a lot of numbers and sounds like a lot of work, but this will make you a better investor and make sure that you're not depending on Wall Street to feed you those forecasts. So now you've got those Wall Street forecasts as well as your own. How do you invest with this information? If your own estimates confirm that low overall return that we see from Vanguard, then I think the way to go here would be a bond-heavy portfolio. Remember, back in that chart, if we see here a similar return on corporate bonds, that 4.2 to 5.2% range, which is only a little below the range for stocks, but with bonds, we get it with less than a third the risk, then that is just a much better risk-adjusted return. Basically, what you want to do here is just park your money, maybe even 30 or 40% of it in safe bonds, and get that return until a better opportunity comes along in stocks. You could also sell covered call options against your stocks, so selling call options at a strike price, say 10 or 15% above the current price. If you're only expecting your stocks to rise maybe 6% a year at best, you're going to collect that premium on those covered calls and still keep the stock when the call option expires. Now, if, however, your estimates for returns are quite a bit different from those analyst estimates, I wouldn't just ignore the analyst forecast. Ask yourself where your estimate might be different, and it's usually going to be in those potential earnings growth. So do you think companies or the stocks in your portfolio can produce those higher earnings growth that you're estimating rather than the Wall Street estimates? But if you still do believe that stocks will produce that higher return than expected, in this case, you'd want to have a stock-heavy portfolio. I'd still hold some bonds and real estate stocks for that diversification, but holding maybe 70 or 80% even of your money in stocks is going to give you that upside potential when returns are higher than Wall Street expects. Get the weekly bow tie free each week before the market opens with the link below, or click on the video to the right for 7 investing rules from Peter Lynch, possibly the greatest investor of all time. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.